As I'm sure most of you have heard by now, Silicon Valley Bank on March 10th was shuttered after a run on the bank. If you're like a lot of people on the internet, you're probably saying to yourself, that was a bank that did high risk ventures and they deserve to go out of business. And the people who were stupid enough to deposit in that bank also deserve everything they get. But in my opinion, nothing could be further from the truth. Let's take a look. Hey y'all, it's Dr. Know-It-All. So 2 caveats before I even begin this episode. First of all, I am not a banker. I don't understand a lot of the macroeconomic stuff that goes on. I don't understand the details of banking. So just, I may make mistakes with this, so understand that. And second of all, of course, this is a breaking story, so facts and information might change very, very quickly. I wanted to get this video out first thing Monday morning because I think it's very important for all of us to keep an eye on what happens with other banks in the next 24 to 48 hours. And that's actually the real big point of what I'm going to talk about today. But first, I want to look at a Washington Post article from today and also a tweet thread from Raging Capital Ventures from the 18th of January, so nearly 2 months ago. Clearly, this person understood that something was already going wrong with Silicon Valley Bank even back then. So to start with the tweet thread, again, this is from January 18th, so almost 2 months ago. Silicon Valley Bank, or SIVB, their stock ticker, reports earnings tomorrow. Investors have rightfully been fixated on SIVB's large exposure to the stressed venture world, with the stock down a lot. However, just dig a little bit deeper and you will find a much bigger set of problems at SIVB. So to set the scene here just a little bit, if you don't know, Silicon Valley Bank is a fairly unique bank in the United States and I think in the world, and that is that they are specifically tailored to loan out money to relatively high-risk ventures. So generally speaking, most banks only like to loan out money when they have a significant amount of collateral or other trust in the person who is taking out that loan. Silicon Valley Bank, I believe they've been in business for about 40 years, has been extremely lax about that, and the main reason why, of course, is that they're Silicon Valley, they're invested in startups, and so they're willing to take more risks in what they invest in. And this, of course, is one of the reasons why people say, well, if there's a run on this bank and they go out of business, no big deal. And of course, I'll get back to that at the end of this video. But I did want you to understand why this is different from a bank like Wells Fargo, a massive bank like that, or even a regional bank like Synovus Bank that's in my area. Continuing on with the tweet thread, Silicon Valley Bank rode the venture capital boom like a champ. Deposits grew from $61 billion at Q4 of 19 to $189 billion in Q4 of 2021. Wow, that's a really, really big increase. Interest rates were so low, these deposits were like free money, around 25 BPS of average cost. Silicon Valley Bank used these inflows to, number one, increase loans 100% to $66 billion, and number two, go hog wild with its, quote, held to maturities securities portfolio, ramping its mostly agency mortgage holdings from $13.5 billion at Q4 19 to $99 billion at Q4 2021. And of course, if you want to pause on this graph and take a look at it, have a good time with that. Continuing on, Silicon Valley Bank's big problems are with its held-to-maturity portfolio. The bank basically increased its security portfolio by 700% at a generational top in the bond market, buying $88 billion worth of mostly 10-plus year mortgages with an average yield of just 1.63% at September 30th. Oops. So basically the problem here is that a bank needs to have a certain amount of liquid cash, and they also, of course, have long-term investments. But you can see that Silicon Valley Bank invested $88 billion in 10-plus year mortgages, which means they have to hold it for 10-plus years to get the full rate of return back. And they did it at only 1.63% interest rate, which seems shockingly low in retrospect now, right? With the Fed having raised rates over and over and over again. So this is a pretty big problem. They have a lack of liquidity and they're not earning much interest on their long-term loans. Next up, Silicon Valley Bank's hold-to-maturity securities had mark-to-market losses as of Q3 of $15.9 billion compared to just $11.5 billion of tangible common equity. That is a big problem, obviously. Luckily, regulators do not force Silicon Valley Bank to mark held-to-maturity securities to market, but the bank would be functionally underwater if it would liquidated today. And remember, this is back in January before all of this stuff blew up. So here we've got at least Raging Capital Ventures had a pretty good idea of what was set to come. On top of this, due to the Fed's interest rate hikes, SIVB is seeing accelerated deposit outflows of about 6.5% year to date, a mixed shift away from non-interest accounts, and skyrocketing interest costs. Money markets now yield 4%. Also, Silicon Valley Bank's venture clients are burning cash. And this, of course, makes sense with rising inflation and higher interest rates. Companies are going to be burning through more cash. So this is a really big deal, and it's putting pressure on Silicon Valley Bank already back in January. Basically, as its funding costs reset higher, Silicon Valley Bank is facing a massive negative carry cost on its held-to-maturity, largely fixed-yield securities portfolio, which is not running off quickly due to the nature of mortgage convexity. The risk for Silicon Valley Bank is that deposit outflows accelerate at such a pace that it is forced to either raise equity capital and or sell down its held-to-maturity securities portfolio, thus realizing substantial losses. You can bet that Silicon Valley Bank is praying for a Fed pivot. And of course, this all sounds really, really prescient right now because that's exactly what happened, and the Fed did not pivot. Now, what Raging Capital Ventures is talking about here is that the Fed would pivot to lower interest rates or not raising them as quickly. But you can obviously see that the Fed did raise that in retrospect, and that Silicon Valley Bank took it right on the chin because of those raised interest rates. Silicon Valley Bank's clients also face a risk. With the bank's stretched balance sheet, will it tighten and or pull back on credit lines? Worse, could customers become uncomfortable with Silicon Valley Bank as a counterparty due to unrealized balance sheet losses? Again, hint, hint. Silicon Valley Bank's management has tried to blame its challenges on its venture-related exposure, which is partially true. However, it is hard to hide from the fact that management bought at the top of the bond market. Tomorrow's earnings and this year should be interesting. Caveat emptor. Of course, caveat emptor meaning buyer beware. So basically, he was warning, or she or whoever it was warning us that this was a bad situation a couple of months ago, which means that anyone paying attention or having read this tweet thread, I didn't read this till today, so I wouldn't have known. But then again, I don't have money in Silicon Valley Bank, thank goodness. But anyway, for anybody who had money in it and had read this tweet thread, I think they probably would have become concerned and maybe started moving assets out of this bank already prior to the March collapse. All right, then on to a Washington Post article from just today as I record this. U.S. says all deposits at failed bank will be available Monday. The extraordinary step eyed if plan to sell Silicon Valley Bank to another institution fails. Lawmaker says Democrats are, quote, praying for a buyer. So let's read through this relatively quickly. The U.S. government announced Sunday night that all depositors at the failed Silicon Valley Bank will have access to all of their money on Monday morning. Separately, the Federal Reserve announced that it was creating a new lending facility for the nation's banks designed to buttress them against financial risk caused by Friday's collapse of SVB. And just real quick before we continue, this is the headline thing. The United States government has stepped in and said they're going to backstop Silicon Valley Bank. Now, there's a couple of things here. Number one, if you're not from the United States or you don't understand the FDIC, they insure any account up to $250,000, which is for us individuals, obviously a lot of money, but for large clients like companies and things like that, $250,000 is a drop in the bucket. And as it turns out, Silicon Valley Bank has about 96% of its depositors, the people who have accounts there, are over $250,000. So that means that very close to 100% of people with money in Silicon Valley Bank are in danger of losing most or all of it. So as many people like me were hoping for over the weekend, this stepping in of the United States government and backstopping it and saying that they will protect the assets of the people who had deposits in the bank that for all they knew was perfectly fine, right? There were all sorts of good ratings for it. Everybody thought it was in fine shape except for people on Twitter, apparently, who knew better than other people in the past. But anyway, all of those people should be protected, and that is a huge, huge step because banking is basically trust. We have our money, we put it in Bank of America, which yes, is one of the mega banks. But anyway, we put it in there and we trust that when we say we want the money back, that it's there. And so this is a huge, huge asset. If you lose trust in the banking system, then everything collapses. So this is one of those things that the United States government, this is a situation where they actually really did need to step in. And there's more reasons at the end. And I know some people are adamantly like this bank should be allowed to fail. It was doing the wrong thing. It was taking too many risks. And I'm going to get back to that after I finish reading this article. And I promise I'll read the rest of it relatively quickly. But I think it's really important to at least get the headline here that the United States government is going to backstop this and ensure that people get their money out of the bank, even if a buyer is not found. Continuing on, today we are taking decisive actions to protect the U.S. economy by strengthening public confidence in our banking system. A joint statement from the Treasury Department, the Fed, and the Federal Deposit Insurance Corporation, or FDIC, said. This step will ensure that the U.S. banking system continues to perform its vital roles of protecting deposits and providing access to credit to households and businesses in a manner that promotes strong and sustainable economic growth. Taxpayers will not bear any costs for any losses associated with unwinding the bank, the statement said. I don't know how that's quite possible, but we will see. The announcement from the Treasury appeared to cover deposits worth more than the $250,000 limit for federal bank insurance, which is what I talked about earlier. The initiative marked the most expansive use of Fed authority since the early days of the pandemic, when the central bank established several programs to ensure that credit continued to flowing to employers and consumers. Under the new program, the Fed said it would provide loans of up to 1 year to banks, savings associations, credit unions, and other eligible depository institutions in return for collateral such as U.S. Treasuries, agency debt, and mortgage-backed securities. So this is an important thing to keep in mind when I get to the end of this article, is the fact that they're not just talking about Silicon Valley Bank, but all banks, savings associations, credit unions, etc. The announcement came after federal officials spent the weekend scrambling to avert a broader financial problem in the wake of SVB's sudden demise. Earlier Sunday, federal authorities were seriously considering safeguarding all uninsured deposits at Silicon Valley Bank, weighing an extraordinary intervention to prevent what they feared would be a panic in the U.S. financial system, according to 3 people with knowledge of the matter, who spoke on the condition of anonymity to describe private deliberations. So at a guess, this looks like an article that was written in pieces, and they've added the part about the fact that they are backstopping Silicon Valley Bank to information from earlier where they said they were talking about doing that. Officials at the Treasury Department, Federal Reserve, and FDIC discussed the idea this weekend, the people said, with only hours to go before financial markets opened in Asia, and I believe they are even as I'm recording this. Certainly they will be tomorrow morning when this video comes out. White House officials have also studied the idea per 2 separate people familiar with these discussions. The plan would be among the potential policy responses if the government is unable to find a buyer for the failed bank. And that's what they're hoping, is that somebody's going to step in and purchase the bank. Who knows, by the time you actually see this article, that may have happened at this point, but I don't know. There's probably not a lot of people who are big enough to eat Silicon Valley Bank and also at the same time want to take on that risk. The FDIC began an auction process for SVB on Saturday and hoped to identify a winning bidder Sunday afternoon, with final bids expected by 2 p.m. Eastern Time, according to 2 people familiar with the matter. As of this recording, which is later than 2 p.m. in the afternoon, still no word about that, but fingers crossed that maybe somebody has stepped in. Selling SVB to a healthy institution remains the preferred solution, officials had told members of Congress. Most bank failures are resolved that way and enable depositors to avoid losing any money. In calls with federal banking regulators late Saturday and Sunday, Democrats said they were, quote, praying for a buyer, said Representative Brad Sherman from California, a member of the House Financial Services Committee. Big buyer, small buyer, fat buyer, skinny buyer, we need a buyer, he said. If they have a bunch of buyers, I would argue you take the best offer, he said, noting that they can, quote, quibble about which offer to take. Although the FDIC insures bank deposits up to $250,000, a provision in federal banking law may give them the authority to protect the uninsured deposits as well if they conclude that failing to do so would pose a systemic risk to the broader financial system, the people said. In that event, uninsured deposits could be backstopped by an insurance fund paid into regularly by U.S. banks. And that, FYI, is why I believe the taxpayer is not supposed to be on the hook for this, is there's a deposit account. There's like an insurance account that every bank pays into. So I believe that's why they're saying that the taxpayer will not ultimately be responsible for helping out Silicon Valley Bank. But of course, with all federal things, there's always a wrinkle to this. Before that happens, the systemic risk verdict must be endorsed by a 2/3 vote of the Fed's Board of Governors and the FDIC board, along with Treasury Secretary Janet Yellen. No final decision has been made, but the deliberations reflect concern over the collateral damage from SVB's collapse, and authorities struggle to respond amid limits on their powers implemented following the 2008 financial bailouts. So again, even though this is one continuous article, I believe that this is outdated information from the beginning, because it looks like they must have voted to be able to make this happen if they were backstopping the whole thing. So my assumption is, again, here that this is relatively earlier news and that the beginning of the article actually trumps the rest of it. And we actually do know that the Federal Deposit Insurance Corporation and others will step in and backstop SVB if no buyer is found. Continuing on, We've been hearing from those depositors and other concerned people this weekend. So let me say that I've been working all weekend with our banking regulators to design appropriate policies to address this situation, Yellen said on CBS's Face the Nation. Officials have grown increasingly alarmed by the prospect that SVB's collapse could lead depositors to move their money out of similarly situated banks and into the safer Wall Street firms. Quote, they're trying to work out legal and politically justifiable way to protect all uninsured deposits, end quote, said one person familiar with the discussions. Spokespeople for the White House, Treasury, Federal Reserve, and FDIC all declined to comment. Any decision to provide unusual assistance to SVB's depositors would likely draw opposition. As discussions continued Sunday, some experts said that problems at the bank and others like it did not pose a threat to the U.S. financial system. Quote, I think it's going to be hard to say that this is systemic in any way, Sheila Barr, former head of the FDIC, said on NBC's Meet the Press. The bank's collapse would cost its shareholders and could trigger economic problems for companies that kept a large, uninsured sums on deposit, said Anil Kashyap, a professor at the University of Chicago's Booth School of Business. But that did not mean the broader financial system would be imperiled as it was during the 2008 financial crisis. This isn't a systemic event. This is a mid-sized bank that was badly managed, he said. It may be a little bit messy, but that's different than if you have somebody at the core of the financial system stop making payments to somebody else at the core of the system. And then the core implodes. The U.S. banking system is highly concentrated, with the top 5 institutions holding almost $13 trillion in assets. Even if other banks that are comparable in size to SVB suffer depositor runs, the overall financial system would continue to function, he said. Bob Hockett, a Cornell University professor who worked at the central bank, said the FDIC has the legal means under the systemic risk exception of the Federal Deposit Insurance Corporation Improvement Act to intervene. That option is still available. If there looks like there could be a bank run on all the non-Jamie Dimon banks, I assume that means the really big banks, they can, in a pinch, insure previously uninsured deposits for the full amounts, Hockett said. They can do this for over $250,000 per deposit. Top federal regulators briefed key lawmakers about the bank's collapse and the government's response late Saturday, with plans to convene again later Sunday afternoon, according to 2 sources familiar with the matter, who spoke on the condition of anonymity to describe the sensitive discussions. On the late Saturday call, lawmakers sounded an urgent note about the need to find a buyer for SVB, and some raised fresh concerns that there could be financial contagion, especially if the U.S. cannot resolve the bank's payouts to depositors swiftly, one of the people said. With fears growing that there could be a run on other small or regional banks, some members of Congress also sought to reassure their constituents that their cash is safe. On Sunday, Senator Joe Manchin stressed in a statement that the banking system is, quote, stronger and sounder now than at any time, end quote, since the financial crisis. Don't know about that one. Quote, I urge the American people to allow the protections already in place to ensure individual deposits and the well-being of local and regional banks, particularly in rural communities like we have in West Virginia, which of course is his home state, to be fully realized before reacting out of fear and amplifying the problem, end quote. So there you have it. You have a mid-sized, maybe regional, considered a regional bank, although it's kind of a weird oddball thing. Anyway, there was a huge run on that. They ran out of liquid cash. They had to be shut down. People are looking for a buyer, unclear whether there is one or not. Maybe tomorrow morning there will be, but in the meantime, the federal government has stepped in and said they're going to backstop this. So you might say to yourself, okay, what's the big deal? You've got a bank. It was badly managed. They had a lot of risky ventures. They did things like hold to maturity bonds and stuff like that at low interest rates. They made a bunch of mistakes. If there's a run on it and they go out of business, oh well, it hurts a bunch of people who are shareholders in it. And there's a bunch of people who are depositing money in it who could also lose a whole bunch of that as well. But those are all rich Silicon Valley people, so they don't need the money anyway. That's the argument that I've heard against backstopping Silicon Valley Bank. The opposite is that a lot of the people, in fact, most of the people who are primarily in danger from Silicon Valley Bank going out of business and shutting down and losing their money are not the big players, right? If you're somebody like Google or Apple or Microsoft or whoever, yeah, you're probably going to have some money in Silicon Valley Bank, but you're going to have it spread out over a whole bunch of banks, including a bunch of the really big banks like Wells Fargo or Bank of America, and probably offshore banks as well, right? So you've diversified where you have put your money in. The danger right now is a bunch of small companies, including my own, although fortunately we did not have money at Silicon Valley Bank, but we do have it in a regional bank. So, so it's a worry tomorrow morning. I'm very, very concerned about this happening. But basically that these are tiny companies to mid-sized companies that might be worth $1 million, $10 million, $50 million, something like that. Relatively small companies that have perhaps all of their equity in these banks. And these are the people who are next decade's Google or next decade's Apple or whatever it is. These are the future of the United States' businesses are concentrated in this bank because it's willing to lend out money to higher risk ventures, which most banks are not willing to. So this is a very, very important bank for the startup culture of the United States. And even if you don't care about that, and I really, really think you should, because this is the thing that makes the future better. This is the thing that employs people in the future. If you have children or something, one of these companies right now that's just starting up, that's just worth a couple of $1 million right now, that could be the company that employs your child in 20 or 25 years. So this is the exact kind of thing that you really, really should care about, because these are at the forefront of innovation and technology. But even if you don't care about that, the really, really, really big thing is that all regional banks, in my opinion, are in heavy duty danger right now. Everybody who has the ability to withdraw money from a lot of these smaller banks, like I said, my bank is Synovus that we have our business account with. It's a small regional bank. I don't know exactly how many $1 billion it's worth, but it's not one of the big ones. And so, there's a danger that a whole bunch of people tomorrow and next week will go like, well, let's just take money out of that and put it into one of the big 4 or 5 banks in the United States instead. And that could cause a run on all of these other regional banks, which is why it's so important that the federal government has stepped in and said, we're not only backstopping Silicon Valley Bank, but all of these other banks. We're going to make sure that you get your money is safe. Because again, banking is all about trust. It's like, I'm giving you my money, and when I want it back, I want my money back. I don't want you to say like, oops, I don't have it anymore. That's a bad situation. So even though they're only worth billions of dollars and not trillions, it's very, very important that these smaller banks and credit unions, et cetera, are healthy. It's healthy for the economy of the United States. And one of the big reasons why is that if you narrow it down, let's say all of these banks close in the next couple of months and everybody puts their money in only 4 or 5 banks and only the really, really giant ones, well, that's going to make the giant banks happy because they're going to have more and more money, but they also have an immense amount of control. And you've got very, very conservative banks. One of the reasons why they're so big is because they're super conservative and they won't take chances. And one of the really big benefits of credit unions and small banks and things like that is that small businesses are able to get loans from these regional or credit union type banks that they're not able to get from giant banks. So if we reduce the banking system to an oligopoly and only have 4 or 5 gigantic, humongous banks and nothing else, that is far to the detriment of the United States, to all of the citizens in the US. And whether or not you're a business owner or anything like that, you want people who are business owners, who are small business owners, who are people who are looking to the future to try to make something happen, change the world, or just open a mom and pop grocery store, whatever it is, in some neighborhood that needs a grocery store. Whatever that thing is, we all need liquid cash out there in the system. And frankly, these smaller banks are the ones who are willing to give that sort of cash out and do loans because they're willing to take more risks, because that's the nature of their type of business. So yeah, it is more dangerous. And Silicon Valley Bank, you could argue, made really, really bad mistakes. Although when interest rates and things like that were super low and the thing was booming, they were very, very happy and they were very, very profitable. So, they did really well for a long time. They just didn't prepare for the incredibly bad series of events that happened to Silicon Valley, to all of us, that, sort of collectively in 2022. So you could argue bad management, and yeah, the people who are in charge, probably the people who are the shareholders, etc. Those people, it's like you took a risk and that was a bad risk. But the people who deposited money and thought that they had money, safe money in this bank, they had no reason to suspect that anything was wrong unless they'd done some really, really deep digging, which is not really the thing, right? When I put money in the bank, I just expect it's there. So I'm like, there's my money. I hope it's there. It's not, it's one of those things where, again, it's a trust system. So if you're a small company and you have like $1 million cash run that a venture capitalist has given you, and you've deposited it in the bank, and you're going to be paying your employees for the next year off of that $1 million, well, it better be there for you to be able to pay your employees. Same goes for any other business. If you deposit it in a regional bank someplace, you expect that money to come back out again when you have to pay yourself or your employees, or you have to purchase goods or whatever that thing is. So the bank banking system really, really needs these smaller banks. It needs to not become concentrated in a tiny group of gigantic banks that are unwilling to lend out things and that control too much of the capital in the United States and, quite frankly, the world. So that's the reason why I'm really, really happy to see what the US government has done. I hope that that stops any potential runs on banks this coming week. You know, fingers crossed that everything will just sort of settle down and it will be no big deal, and SVB will be sort of a one-off sort of deal. But, you know, it smacks a little bit too much of 2008 when, was it the Bank of Washington Bank, another really, really big regional bank, had a huge run, went out of business, and that was a harbinger for a whole bunch of other banks. And we can dial it all the way back to 1929 when a huge number of banks had runs on them, and that, you know, caused the Great Depression in the United States and in lots of the rest of the world. So, you know, these are situations you got to be really, really aware of. And I know this doesn't directly affect Tesla or any of its stuff, but I still think it's worth talking about. And it could affect Tesla too, because they probably have some deposits in there. But even more so, maybe there are little companies that are giving Tesla some, you know, materials or products or parts or something like that, and they had their money in Silicon Valley Bank, and then they won't be able to pay their employees, which means they can't give Tesla parts, which means that Tesla then can't produce cars or whatever because they need that particular part for the car. So, you know, you're looking at things, there's a lot of knock-on effects if people don't lose that access to that money. So even if you think that a dumb bank that makes dumb decisions should go out of business, and anyone who is dumb enough to put their money in that should lose their money, I think that you're thinking too short term. I mean, take whatever bank you've got your money in. If that bank suddenly went out of business and you were like, oh crap, where's my money? I think you would change your tune. And so most of these people, the depositors, are not big bankers. You know, they're not people who understand the ins and outs of these kind of crazy things that banks actually do behind the scenes. They just want to put their money in, make a small amount of interest, get their money back out when they need it. That's all they want. And the more of those kind of banks, especially regional banks, smaller banks, credit unions that are willing to give out higher risk capital, those are very, very necessary for the continued robustness of the US economy. So that's my opinion. I'm sure I will hear a lot from what you all have to say about that in the comments. Definitely let me know if you agree, if you disagree, whatever it is. But please do be, you know, polite about it and constructive in your criticism, and you know, also provide other alternatives if you think this was not the right alternative for the federal government to do. What do you think the right thing for the feds to do would have been? All right, I hope you enjoyed this video and found it fun and interesting and thought-provoking. If you did, please do like it so other people can find it. I think it's important, even though this doesn't tie in directly to Tesla, for us to talk about these things because, quite frankly, you know, banks are the core of making things work and of startup companies and all of that kind of stuff. And even if Tesla is immune to a lot of this stuff, again, a lot of the smaller companies that work with Tesla are not immune to Silicon Valley Bank's closing. So I think it's a very important thing that the federal government has done what it did. But of course, if you disagree with me, I would be very interested to find out. Definitely let me know in the comments. Just keep it constructive and polite. That's all I ask. If you want to school me, go ahead and school me. That's totally fine. As always, a huge shout out to my patrons on Patreon. Thank you all so much for your support. It's been a wonderful 2023 so far, and if you want to join the team, just check out the link in the description. And if you're interested in a whole bunch of really cool merch, check out our merch store. Link is in the description. We have TeslaBot t-shirts, the Tesla meme t-shirt, Success is a Possible Outcome, 4680 battery cells. All of that stuff is on t-shirts, mugs, tumblers, and on. So check it out. And finally, don't forget, we are both Tesla and Amazon affiliates. If you look in the description, you can see how going shopping for a solar roof, a power wall, or anything on Amazon helps out the channel. In the meantime, I'll see you in the next one. Bye-bye.